All right. All right. So we are back. Once again, welcome everybody. Any new person here? Any new person? Bata really want to steal my name. Oh, see, Bata. Nearly. She just put, either she or he, she just put, remove A and put E and add A. Wow. So who is Bata? Can you say hi to us?
Yeah, good afternoon. My name is Beta.
Why did you want to steal my name?
Oh, that's your name?
Okay. My name is Bart, B-A-R-T-H.
Oh, wow.
So you just remove my A and put E and add A after H. Wow. So you're welcome. Is this your first time coming here?
Yes, sir.
So who is your business partner?
Dr. Ruth.
Oh, wow. Which state are you from?
I'm from New Jersey.
New Jersey. Oh, New Jersey.
Yes.
All right. So you registered for your exam?
No, Dr. Ruth just invited me, so.
All right. So I know Dr. Ruth will not leave you until you pass that exam. She will be on your neck.
Yes.
Until you pass that exam, so you're not going back. Oh, Dr. Olomba, can you speak to us? Go ahead.
Yes, Engineer Bab. Good afternoon. How are you?
You're welcome.
My business partner is in your class. I think this is her first time. I may be wrong. Her name is Jillian.
Jillian? All right, Jillian, you're welcome.
She was supposed to do her exam yesterday, but because of the weather, they canceled it.
Yeah. Oh, sorry. So, yeah. Jillian, this is the best place you can be to refresh your brain before the exam coming on next week. I know you're going to put it next week, by God's grace. I hope so. So, Jillian, you're welcome. What state are you calling from, Jillian?
Hi, I am in Houston, Texas.
Oh, Houston. Oh, just my backyard.
Okay.
So you're welcome.
Thank you.
Have you been able to go through Texas section of the exam?
Yes, I did. I have been able to do that over the last couple of days. I did it.
All right, that's good. That's good. So what you're going to hear today is just we help you on the revision. So you go back maybe Tuesday or Monday to write your exam. You're welcome.
Thank you so much. Appreciate it.
Just so you know, but she's a champion. She's only studied for this week only, and she's ready for the exam.
Oh my
she's
God. That's a phone board there.
Yeah, there she is. Yep.
That's a phone board there. So, Gillian, we're gonna see you in Dallas. I hope so.
Yes, definitely. I plan to be there.
Oh, that's wonderful. That's wonderful. So, any other new person in this place? Any other new person? I know everybody had. Mr. Kevin, you're welcome. Mr. Kevin, I think yours is counting maybe in Friday or what? You're welcome. Mr. Kevin? Oh, he's not. He muted himself.
Maybe I don't know, he's not responding.
Yeah, his exam is coming very, very fast. All right, so everybody here is, we all know ourselves. We know the way we do our things. Just like I said, here, nobody's teaching anybody. All of us, I'm just a moderator, we are trying to break it down to our own understanding so that in the exam, we hear all of us voice. It's not a question of hearing anybody. You hear your voice as you contribute. When you go to the exam, whatever you say out retains in your mind. That is just the truth. And bothered by that, we are clouded with a lot of things, home, front, job, bills, and this and that. So that's the reason why all of us are here. Independently, all of us can pass this exam without even coming to here. That is the truth. But our coming here is to make it interactive so that everybody will participate in the discussion. Ask question anywhere you don't, any of the explanation you don't know, ask question. Don't keep quiet. No, but I don't think anybody is below 20 years here. All of us are the adults. And no question is silly question. All questions are good. We put it together, we explain on it, we interact on it, so that everybody will remind him or herself what it is when you see it in a hall. So somehow, everybody, welcome. We're going to go today on chapter 7. I said before I went online, I said chapter 5, 6, and 7 are predominantly what you're going to see in the exam. Every other chapter here is just an introduction. Then chapter 5, 6, and 7 is basically what is in insurance. Chapter 8 is group life insurance, talking about the kind of insurance you get at your job. So that one is, you're not going to see much of it in exam. However, you see it, but not as compared to what is in insurance, which is chapter 5, chapter 6, and chapter 7. Then chapter 9, which is annuity, is a section of insurance, which we say is opposite of insurance. Annuity is an opposite of insurance. Most often we said life insurance creates estate and annuity liquidates it. So it's just an opposite of life insurance. Then chapter 8 is uses of insurance. Chapter 10 is uses of insurance, which we know definitely what insurance for. Is not only to protect us, it's also to create estate for us. Now, chapter 11 is retirement plan. Whether you like it or not, one day you must retire, which means chapter 11 must be very important to all of us. For me, I have retired. I know what I'm passing through now. I know the rigors that I'm passing through in terms of the insurance, the one who have a job, the health insurance, all of them put together is a mess. Honestly, it's just when you come out, you now understand that all those things they used to bring you into a job, we have a group, we have a benefit group, we give you group life insurance. All of them are just babash. Immediately you step out of that place and give them your ID, it's no longer, it's just nothing. So we will quality look at social insurance, where the Social Security belongs, where the Medicare belongs, where the Medicaid belongs. So we're going to see all those in chapter 12. And of course, chapter 13 is telling us about health insurance, health and accident insurance. This one becomes the benefit. I always say the benefit of health insurance is what's care. Then the benefit of life insurance is protection. That is what it is. The benefit of health insurance is care. The benefit or the proceed, all right, let me use the word which will make so much good meaning to everybody. The proceed of health insurance is what? Care. And the proceed of life insurance is what? The money, the cash, the benefit, the money you are receiving. So that's why more attention is being paid on the money aspect of it. Remember, finance is the most regulated thing here, particularly in America. If everybody is listening to what is going on in Minnesota, you see that government do not play with finance. Honestly, anything called finance, fraud related to finance, they don't joke with it. So chapter 13 actually is what is telling us health and life accident insurance. Then chapter 14 is called health insurance providers. Those ones that are using to cheat us, you guys don't know. They are just using us. Medicare is here, Medicaid is here. Part A is there, Part B is here. Part D is there, which is prescription. Why Part C? Combining Part A and Part B. Those things, anybody who enter there will just develop one thing and tell his brother to manage it and be eating from the same money. And what is that money? The money you have saved in Medicare, which is about combining it with your Social Security, about 7.65% from your paycheck every time you are paid. And this government, they now go say they give you Part A, Part B, Part D. Of course, they now introduce Part C. Under Part C, they are introducing PPO and all the rest, just to make sure that money is gone. So we're going to see it on chapter 14, and chapter 15 is telling of medical expense insurance. There's something. So, and chapter 16 is disability. So let's go back to chapter 7. It's very important. I want everybody to pay attention. Let's do it together. Ask questions where the explanation is not clear, so we can understand it well. So chapter 7 is life insurance underwriting and policy issues. So before now, we don't know that why underwriting come to be is not because they want to introduce this. They introduce underwriting in the business of insurance just for themselves to make sure that they don't pay much. You know the reason? Before now, there is this what we call adverse selection. It has been almost there. Everybody applying for policy and getting approved without anybody scrutinizing it, without anybody going to them to see whether this person have this risk or the other risk. If you apply, you'll be approved. If you apply, you'll be approved. So the insurance company end up paying a whole lot of benefits to people. Paying a whole lot of benefit to people. So at the time, they say, look, this thing will take us out of business. They now sit together and bring what we call underwriting process. So the underwriting process came in to check adverse selection. And what is adverse selection? The tendency of those who are highly at risk to seek for life insurance coverage. So that's why underwriting comes. So we're going to look at underwriting today and what actually they do in the policy and how they help to make sure that the insurance company benefits. If not, they will run out of business because almost everybody, from somebody who is almost about to die, they can put policy on the person and is approved. That's how it is before, but not now. So let's look at this small explanation, which we will call see at the video. It said, have you ever wondered how insurance companies decide who to insure and at what cost? We're using Maria. Maria applies for life insurance to protect her family. What determines whether she will be approved and how much she will pay? The answer lies in a process called underwriting. The foundation of the insurance industry. You see what I said? Underwriting is what the foundation of insurance industry. So underwriting is the backbone of insurance industry, balancing insurers' need to manage risk with consumers' need for fair access to protection. So imagine you are helping a client complete a life insurance application. Now you as an agent, of which all of us will be, somebody like Julian will be agent in the next 2 days, I pray so. So imagine you are helping a client complete a life insurance application. They ask, why do they need to know so much about me? Why do you want to know? The agent is asking you because, when you're writing policies for somebody, it's like that person is emptying himself to you. Nothing to hide again. The person have told you everything. When somebody tell you his financial situation, his health issues, his family, everything. So when you are an agent to somebody, you are completely emptying, the person completely emptying himself to you, which means you know that person well. And that's why HIPAA come in. So any information that such a person give you, you have to adequately, confidently protect it. So the person asks, why do they need to know so much about him? So in this chapter, we will discuss, we will learn how insurance companies evaluate applicants like you, clients, balancing the need to offer fair coverage while protecting themselves from excessive risk. So that's one of the things we see. Underwriting might seem mysterious at first, but it follows logical principles that you can easily understand and explain to others. So that's why I said this chapter is very, very important. So from the moment you help a client complete an application, you see, I want you guys to look at this word. I want everybody to pay attention to this word, help. See, the moment you help a client, but some of those clients you're going to talk to don't know that you are helping them. They thought they are doing you a favor. So that's one thing everyone should understand. They thought they are doing you a favor by coming for you to write application for them, write insurance application for them. There's one thing you should understand. In insurance, remember the contract in insurance, we say is between two people, the insurance company and the policy owner or the insured. So that's the two people that are involved in this contract. Remember the insurance company who wrote the policy, who wrote the contract, called it contract of adhesion, which means either you need it, you take it or you leave it, have never come out to beg you to come and write policy with them. Of course, you made the offer. In every contract, there must be offer and acceptance. And you, the applicant, made an offer to insurance company. It's not the insurance company that made an offer to you. You make an offer to an insurance company. So as you, that is an agent, if you approach somebody that you want to help him to write an application or you want him to get policy, you are actually helping the person. That person is not doing you a favor. Rather, you are doing the person favor. So this is what everybody should know. But however, based on the community we come from, you still have to explain to them the need for them to have it. That is very, very important. But however, when they understand actually what you know today, they will know that you have done them favor. They will thank you later. So in this chapter, you will learn about the information underwriters collect, how they classify applicants into different risk categories, and what happens when the premium is collected. In chapter 6, we did how to calculate premium. What things that we do, we use to calculate premium. We discussed it in this chapter, in the last chapter 6, where we said the premium calculation is based on 3 phases: the mortality, the interest, and the expense. So that is 3 factors we need in calculating premium. Today, since we are now into underwriting, we're gonna find out why and how these factors come out. So that's one of the things we're gonna find out today. So they classify applicants into different risk categories. That's what the underwriters do, and what happens when the premium is collected. Of course, we have already known if you pay a premium to your policy, the premium is distributed to so many channels. We already know that. We discussed the channels the premium can go. We said part of the premium will go to expense, part of it go to claims, parts go to commissions, and some of them go to cash value. Most importantly, for policies that has cash value. So I'm trying to do, and I'm counting so many other things. So for example, when your client, Mark mentioned as weekend skydiving hobby, of course, not that skydiving is a high risk things. So we're gonna do step by step to find out what underwriters do and how they come into life insurance. Agent responsibility and proper solicitation, the purpose and characteristics of life insurance underwriting, the application, additional sources of underwriting information, and initial premium and receipt, policy issue and delivery. So that's exactly what we're going to see. It's a lot. And this chapter is so big that it's very, very important for everybody to know it. So before we go ahead to look at the terms, let's just watch this video. It's just a small video. It's just an introductory video. It's going to tell us what we're going to learn in this chapter. Then we're going to go in to look at the terms. Remember, there's no way you can pass this exam without knowing the terms. No way. I'm telling you the truth. Even those who go only to do the questions. If you enter the hall, you're gonna mess you up, because sometimes you see some things you don't know what it is. But if you first understand the terms, it becomes so easy for you to go to the exam and pass. So let's watch the video and see what it's telling us.
Welcome to the Life Insurance Underwriting and Policy Issue chapter of your insurance course. In this video, we'll explore how insurers decide who to insure, at what cost, and under what conditions. Let's start with a question. Why do insurance companies ask so many personal questions when you apply for life insurance? The answer lies in underwriting, the process that balances risk and fairness. It's the backbone of the insurance industry. By the end of this chapter, you'll be able to explain the agent's role in underwriting and solicitation, define insurable interest and when it must exist, explain the purpose of underwriting and how it helps prevent adverse selection, identify key parties in the underwriting process, outline the 3 parts of a life insurance application, compare sources of underwriting information, classify applicants into risk categories, Explain how premium receipts affect coverage. Describe policy issuance and delivery. And finally, recognize consumer protections like disclosures and the free look period. Let's begin with the agent's role. As a field underwriter, you're the first line of defense against adverse selection. You'll complete applications, collect premiums, and ensure disclosures are properly delivered. Next, we'll explore insurable interest, the financial or emotional connection that makes it appropriate to own life insurance on someone else. Without it, life insurance turns into a wager, and that's exactly why insurable interest must be present at the time of application. Now let's look at underwriting, the process insurers use to protect themselves from adverse selection, which happens when higher-risk individuals are more likely to apply for coverage. To evaluate risk, underwriters rely on several tools: the application, medical exams, APS reports, and the Medical Information Bureau. Underwriters also look beyond medical data. They review credit reports, motor vehicle records, and specialized questionnaires, especially for hobbies like skydiving or aviation. Using this information, applicants are classified as preferred, standard, or substandard, each category tied to different premium rates. In some cases, however, the risk of a premature loss is simply too great. When this happens, underwriters must decline the application entirely. These are known as declined risks, situations considered uninsurable due to the severity of the risk involved. Let's talk about premium receipts. If a premium is paid with the application, a conditional receipt may trigger coverage, but only if the applicant proves insurable. A binding receipt, though rare in life insurance, guarantees coverage until the insurer makes a final decision. Once underwriting is complete, if the application is approved, the policy is issued and delivered. This is the producer's opportunity to walk the client through the details, including policy provisions, optional riders, and any exclusions the client should be aware of. Now, the free look period gives clients at least 10 days to review and return the policy for a full refund. As an agent, your professionalism during delivery builds trust and sets the stage for future business. This chapter is packed with real-world scenarios and exam tips to help you master underwriting and policy issue. Let's get started. You're about to gain the tools to guide clients with confidence and pass your exam.
All right, that's it. I think everybody can see that this chapter is the real deal. It has a lot of things that you may expect to see in the exam. Let's look at the keywords. I always like to go through these keywords. They are very important. Sometimes, believe you me, if you just know the keywords and enter that hall, you're gonna pass. Because every question is related to one or two keywords. Remember, we talked about adverse selection, what it is. I told you why underwriters business come into insurance because of adverse selection. If not adverse selection, there'll be no underwriting. Underwriters were introduced to make sure that this place I highlighted, adverse selection, are checked in insurance, life insurance business. So it's the tendency of higher risk individuals to seek insurance coverage. So what does sound underwriting practice helps what insurers identify and manage this risk to maintain fair premium for all policyholders. That is adverse selection. Everybody who's sick will always go for life insurance policy. But the problem nowadays is this: when you are sick, you go, they will not approve you. And when you are not sick, somebody will come and talk to you that it's good for you to get policy. You will refuse. Now, when you are sick, some of the family members will run around to see that they get policy for you. You see the irony. When somebody is with good health, you'll be talking to that person, pleading, please have a policy. The person will tell you, I got it all. I don't know, I don't need it now. I don't need it, I got it all. But immediately he or she is sick, the family members, even himself, we're now going to find a way to what? Get insurance policy. Why is it like that? Why do people don't want to get it when they're supposed to get it and want to get it when they're not supposed to even look for it? So that's the question all of us will answer, and that will prepare you even to go, and when you are speaking to people, that give you the courage to explain to them why they should get this on time and not to wait until when they don't, when it's very, very difficult to get. It now brings us to our children and everybody around us, more especially our children. No amount of policy is small. Try and get as small as, in fact, try and get a policy no matter how small it is. It's better to get small than to get nothing. Our children, make sure you get policy for them, more especially when they are still so young. I'm telling you the truth, that at the time you may need it, they may not be able to be approved. When they begin to go to that clinic, that visit to their doctors, I'm telling you the truth, 1 or 2 factors may come out, and those children may be denied of policy. So do it now. That is the best time to do it, now. Tomorrow may be too late. And moreover, by what we learned on the previous chapters, we said the earlier the better, because the premium will be low at the early time than getting the policy at later time. So let's look at attending physician statement. These are one of the reports the underwriters use in formulating your risk, in formulating your premium. The attending physician statement, APS, is a report from applicant's doctor. Normally, the insurance company is going to ask this APS from your doctor, more especially your primary providers. They will ask for this, and they will write every details about your medical information and give to them, the insurance company, and that's what they look at in denying or approving you. Who they send it to? The underwriters. So that is the attending physician statement, APS. It's very, very important in deciding whether somebody be approved or not, because it contains your medical health information. The conditional receipt. Of course, we have 2 types of conditional receipt. One of them comes up the time you are filling application, you are submitting that application with initial premium. You as an agent will give the applicant a receipt. That receipt does not show that the application will be approved, no. That receipt shows that you collected money from that person, initial premium. But the good thing about it, submitting application with initial premium is this. When the application is finally approved, the effective date of that policy will become that date you submit the application with initial premium. So you can see that it's good. And there's a question that normally comes from it. Like when somebody sent out his application with initial premium, and on the process of underwriting, the person dies, they normally ask, will that person, that family receive proceeds or death benefit? So we're going to see such questions here. And no, that's why I said this chapter 7 contains a lot of scenario questions. So such questions, we're going to see them and we're going to know how to answer them today. So the conditional receipt is a document provided when a premium is collected with an application that establishes when coverage begins. It establishes when coverage begins. But you can see that most often what we do nowadays, we do not collect application with a premium, with initial premium. What we do is to go online and fill the application, submit the application to the underwriter. And when you submit the application without initial premium, it's called what? Who can remember?
Trial.
It's called trial application. Yeah. When you submit application without initial premium, it's called trial application. It's because, remember, you have not fulfilled your own consideration clause. So there is no contract at all. Even you have not made the offer to say, the offer is when you submit the application with the initial premium. That is when you made an offer. If you submit without the initial premium, you have not even made an offer to insurance company. offer starts when you submit the application with initial premium. That is when you make an offer to the insurance company. Insurance company will accept the offer by going through the application, either approve it. If they approve it, do you have a policy then? Not even consider to you that you have a policy until what? When you return your receipt, when you accept the counter offer which insurance company make. Let's also go deep. We should not go deep until when we get over there. So the conditional receipt is that receipt the agent give you when you submit the application with initial premium. That is the conditional receipt. And if finally a policy is issued, what happened then? The effective date of that policy becomes the date you submitted the application with initial premium. There's a whole lot of questions based on that. Is because insurance company will always want to block where they can be hammered in terms of them paying proceed. However, we have clauses and provisions. Most often the provisions benefit the insured, which is you, and the clauses benefit the insurance company. So based on the provisions, there is always a provision that helps consumer to be able to bypass all those chains, blocks that the insurance company will bring. So submitting conditional receipt is very, very important. I mean, submitting initial premium with the application is very, very important. It has a lot of advantages. So feed underwriter. Who is the feed underwriter? Is you. You are called either the agent or the producer or the feed underwriter. So when you pass the exam and begin the business, you are an agent, you are a producer, and you are a feed underwriter. So most often you see the questions and they'll be talking about producer. Your mind be going to say, you'll be thinking is an insurance company. No, they are talking about you. You are the producer, you are the agent, and also you are the feed underwriter. Meaning in insurance business, you have two underwriters. One is you, the feed underwriter, the first contact of the insurance company with a client or the customer. You are the first contact the insurance company have with the client or the customer. Then the next underwriter is the office underwriter. That one who sits on the office and approve or deny policies. That is what the office underwriter. So you are the feed underwriter. Who remains the first contact the customer or the client we have with the insurance company. Remember, as a producer, a feed underwriter or an agent, you are representing the insurance company. So of course, we come to know the agency contract. That's when we're talking about the contract you as an agent or a producer or a feed underwriter have with the insurance company. So in that case, you see that whatever you do is believed to be what the insurance company will do. So we look at agency contracts in future. So there's another one, fiduciary capacity or responsibility. Of course, remember, we a little bit talk about the agent's contract. When you, as an agent or producer or feed underwriter, you are working with the insurance company, which means you have legal obligation to do what they told you to do. You have to represent their best interest. And however, in as much as you represent the best interest of the insurance company as their employer, you're equally going to represent the interest of the insured, which is their client. But if you become a broker, you now see that you are no longer working for the interest of the insurance company. You are working now in the interest of the insured. You represent the insured. You represent the insured. So we're going to see a closure of business, how the broker and the agent differs. We're going to see it in future. So as an agent, you are legally obligated to an insurance producer, which is insurance company, to act in the best interest of their clients when collecting premiums and providing advice. That is one of the things you do as an agent. You collect premium and you educate and provide advice to their clients. You see, that would tell you, that was why you see us answering financial professionals. Because at this point, when you get their license, There's a lot of things you know about finance that any ordinary person does not know. So it's your duty to educate the person. Sometimes you may be talking to somebody, the person, wow, wow, wow. That is the impact of education you're going to provide to that person. And that will make that person to understand the need for that person to have life insurance coverage. Not only life insurance coverage, annuity. So these are the things we should know. Of course, we said previously that annuity liquidate estate. So the better you have life insurance annuity, that's when you know that your retirement is now balanced. Because you create the estate and you liquidate the estate. So meaning if you're here, you have 401k or 403b anywhere where you have not been working, where you have come out from, you're no longer working there. The best thing you can do is to roll it over to annuity so that you put it in a portfolio that will liquidate the estate you're going to create. So put it over to annuity. That will help you not to participate on the loss, but only participate in the gain. So we talked about free look period. What is the free look period? When you submit that application, there is an agent, a producer, or field underwriter, you help your client to submit the application. The insurance company the underwriter will go through the application, approves it. When they approve it, now the underwriter will inform you, the agent, for initial premium payment. And if that premium is paid, the underwriter will approve the application. I mean, at that point, you see that you have paid your premium and you have submitted the application. What happened? The policy can be issued. Now, the underwriter or the insurance company will now do a counter offer, what we call counter offer to you, to the applicants. They make a counter offer. Remember, you are the first person that made an offer. They accept by going through the application and they finally approve the application. They will now make a counter offer to you. What's that counter offer? They send you a booklet. In that booklet contains your policy, the policy summary, the policy premium. Everything about that policy is in that booklet they're going to send to you. They give you 10 days to go through that policy. And that 10 days is what we call free look period. You use that 10 days to go through the policy. If you like it, the counter offer they made, good. If you don't like it, good. If you like it, what happened? You will sign what we call the delivery receipt. The delivery receipt. You sign the delivery receipt.
I just got mine this morning.
And sign statement of good health and send back to the insurance company. When you send it back to them, what happened now? The contract is now binding because you have accepted the counter offer. After you submit those things, the contract becomes binding. You can no longer do any amendment on that contract without the approval of the insurance company. And the insurance company cannot do anything in that contract without your consent. They must inform you that, look, they want to do this or they want to do that. So every changes you want to make, most times, will be within that free look period. And this free look period, most times, I always want people to write it down. You write it down freely because states differs. Here in Texas, the free look period is 10 days. 10 days, when you use an agent to bring the booklet to you, the free look period is 10 days. 30 days, when the booklet was sent to you through mail, they give you 30 days as a free look period. But when the agent bring the booklet to you, or the insurance company bring the booklet to you to your house without mailing it, the free look period is 10 days. And or if they mail it out to you, you get it on your mailbox, the free look period is always 30 days. So again, check your state. The national is 10 days and 30 days. Check your state. Free look period also exists in health insurance. So check your state to find out what is the free look period. Check your state. It's the duty of everybody to check his state. For if you are here in Texas, the free look period is 10 days. For when they brought the booklet to you, and 30 days when they send it to through mail to you. So that is free look period. In that free look period, any question?
I want to ask you something.
Uh-huh.
Based on the booklets they will send to you.
Yep.
The booklets, because I just got mine about 1 hour ago. The
Good.
certificate of good health, will it be inside the booklet? Because I've not opened it.
Yes, it's there.
It's there.
There is a two paper you're going to sign. If you sign it, you can scan it and send to your agent so that you can forward it straight to the insurance
After the
company.
class, I will call Dr. Ruth.
Yeah. So in that booklet, if you open it, you will see statement of good health. You will sign it,
Okay.
and you sign delivery receipt. Those are two things you're going to sign. Sign
Okay,
it,
sir.
scan it, and send to him. The reason why they send you, they want you to sign statement of good health. Remember, from the time you wrote the application till the application is approved, till now a counter offer is made. Now the process you are now is a counter offer. It's assumed that the policy is not binding yet. You can make any changes within now the free look period.
Okay.
So they send you the policy booklet by mail, which means your free look period should be 30 days. So within these 30 days, you have to do what? Go through the policy, make sure that what? You understand it, approve it, then sign the two receipts, the delivery receipt and the statement of good health, and send back to the insurance company. That means you have accepted the counter offer.
Okay.
Excuse me, sorry. So you are just in the process now.
Okay, sir.
Check on the booklet. Probably after this, can discuss with Dr. Ruth on the best thing to do.
Yeah.
However, there are some policies that you may not see statement of good health. But if you get your own, just check it. Check it. There are some policies you may not see statement, but delivery receipt must be there. Check your own. You get the two, sign it, and make sure you get it to Dr. Ruth. All right.
Okay.
So another thing we are going to talk about is the what? Insurable interest. Do anybody understand what is called insurable interest? At this point, we should know what is insurable interest is.
Yes, well.
Anybody want to say something on it? Does anybody want to say something? I told you this is an interactive class. Anybody want to say something on insurable interest?
You don't have to have insurable interest to somebody you do not know, a stranger. That you must know somebody before insurable interest will exist between you and the person.
All right. So you got it, Carl. The thing is this: you cannot write insurance policy for somebody who you do not have insurable interest. Insurable interest is that factor that if this person, anything happens to that person, you will have a loss, a justifiable loss in terms of cash or any other way that will affect you more seriously. That means that you have insurable interest on that person. And this insurable interest we are talking about only exists at the time of application. Insurable interest exists at the time of application. But it does not exist after application. But however, it does not exist during claim process. However, when you write a claim, when you are the policy owner and you are the insured, you are a policy owner, the other person is the insured. For instance, if you are the policy owner, like you are the mother, and you have a policy for your son or for your daughter, or for your grandfather, or for your grandma, or even for your parent, and if anything happens, during the claim payment, they want to verify whether there is an insurable interest exists during the before the application was made. So that is one of the things they're going to find out when you are doing the claim process. But if not, insurable interest exists only during application. After that, there's no more. is it only on that situation where you are the insured, where you are the policy owner and not the insured. And again, you are the beneficiary. If you are the policy owner and the beneficiary, that is when they want to find out whether insurable interest exists. Any question? So that is insurable interest. A financial or emotional relationship between parties that justify one owing life insurance on another. Insurable interest must exist as policy issue and is automatically presumed in certain relationships: spouse, parents, children, business partners. Your parents, your business partners, your children, all those you have insurable interest on them. Your cousins, your nephews, all of them you have insurable interest. Meaning you cannot have insurable interest on somebody you do not know. Meaning what? You cannot write policy for somebody. You cannot be a policy owner to somebody you do not know, particularly to a stranger. If you do that, it's a fraud. You cannot do that. If you do that, it's a fraud. So that is insurable interest. So let's talk about Medical Information Bureau, MIB. Just like APS, we talk about APS. MIB just like an APS. The underwriters go to the MIB to be able to get your medical data. It's a medical data where you get all the information concerning everybody. What you need to access the MIB is just your name, date of birth, and social security. You access MIB. So the underwriters go to the MIB to find out whether you are to find out and know the risk classification you belong. So when you go to hospital, when you have driving record, when you have accident, all those are in MIB database. So the insurance underwriters go through the MIB to find out whether something is wrong, and moreover, the classification they will put on you, the risk classification that will match you, and that will help them to know whether they will approve it or they will deny the policy. Then the next one we're going to talk about, representation.
Engineer,
Uh-huh.
please, before you proceed, the MIB, after they've gotten all the information, who do they send it to?
All right. After they get all the information, I saw that question most often. After they get all the information, that MIB should go to, remember, the underwriters look for the MIB, they got the information. The question I see, we say they send it to the medical doctor. They don't send the MIB to you, no, to the applicant. They don't send it to the applicant. Actually, the MIB is supposed to be seeked by the underwriter, and the underwriter will use it for his own information analysis. But the question, most often the answer will be, say, they send it to the physician. I can't really explain that the MIB will go back to the physician, because the physician is not going to do anything from it. However, some of the information that the MIB comes from the physician.
Yeah, okay.
So the recent,
Because I never asked that question, that's why I'm asking.
yes, the APS, which is the another information from the physician, the underwriter will seek the APS from the physician, and the physician will give it to him. So underwriters go to the MIB, he get the information, he uses for his own work. So I don't think he will still send back the MIB information to the physician. But the answers we see always say the underwriter will send it to physician. All right. So let's talk about representation. In insurance business, you make a statement, you fill the application. The statement on the application, you do not do it with 100% guarantee or warranty that is correct. The material things that is inside that statement you made on the application are correct. However, you are mandated by law to make a statement that are very much correct to the best of your knowledge. So based on that, the statement you put on the application are called representation, because to you, you did it to the best of your knowledge. So representation are statement in your application. Those facts that the agent got from you that are in the application are called representation. You do not call it, oh, you put application, maybe you put it a statement. No, it's a representation which you did to the best of your knowledge. It cannot be warranty. If you say those statements, you guarantee that those statements are correct, then you'll be committing a felony. If there's a found out there's something wrong on it, definitely there may be something wrong on it. You can misspell your name. You can put information such as the date of birth, the month may be wrong. Anything can, even your addresses can be somehow wrong. Your addresses, the spellings may be wrong. There's a lot of things that may go wrong, not intentionally, So that's why the statements on the application are called representation, which you made to the best of your knowledge. So that's meaning of representation. Risk classification. Who does risk classification is the underwriter. The underwriter get the information from MIB, APS. They interview information from the agents. All those put together, we now classify you where you belong. We have 3 recognized standard or way of risk classification that will come out in the insurance exam. One of them say preferred. When you start the business, apart from preferred, you see preferred elite, something like that, but let's not talk about it now. That one depends on individual insurance companies. The only thing classification that is recognized here for this exam is what? Preferred, standard, or substandard risk. These are the 3 ways, 3 classification the underwriters give to every applicant. So based on those classification, either you be denied or you be qualified. Preferred is the best, standard is the normal, substandard is the worst. So most times when you are classified substandard, they may go ahead to deny you the policy. So these are the 3 classes of classification. We know there's percentage attached to them. Either 25% is either 15 or 25% is preferred. Then standard percent is 0, which is the normal. Then substandard is about 65 or 75%. What I mean by this percentage is the premium. If you are classified preferred, you pay less, 25% or 15% less than standard. If you are classified standard, is normal premium. If you are classified substandard risk, you are going to pay 75, either 65 or 75% more than standard. So you can see why this risk classification is very, very important. And they're going to get a lot of information on doing this risk classification, including the kind of job you do, including your hobbies, what you like to do. So all those are part of things for information they need to place you on the particular risk classification you will be, including your age, your sex, all those things are there. What age are you? Are you a male or female? Those are things that help them in doing the classification. Of course, all of us here knows that when you are a female, you pay less in premium than when you're a male. Even a newborn baby and a newborn baby girl or a newborn baby boy are not going to pay the same premium. They born the same day. Let's assume they born even yesterday, and you are putting policy for them today. 2 of them will not have the same premium. That of the male child will be higher than that of the female child. So, of course, the process of evaluating applicant to determine insurability, appropriate risk classification, underwriting involved was analyzing information from various sources to decide whether to issue coverage and at what premium rates. So that is underwriting. So let's go now inside the content. Totally, it's a lot. I'm not sure we're going to finish today. This particular chapter is a lot. So I'm not sure.
We can if you extend the time.
Yeah. No, we're not going to extend the time. I have some of that in the next 2 hours. So it's very, very important. Please pay attention. If you do not, any of the terms you don't understand, let us discuss it. Even if all of us, if you discuss one and everybody understood it, even if we cover one today, that'd be enough. than to cover all of them, and we do not get it. When we see it in the exam, we not get it correct, please. So it's better we do it good. So let's go. Let's talk about the agent responsibility. Remember, you can be referred as an agent, you are the feed underwriter, and you are also a producer. Insurance producer is you. Insurance agent is you. Insurance feed underwriter is you. So these are the three names you have to know. If any of them come in the question, don't look at maybe it's another person. Particularly the one that confuses a lot is producer. It confused me even when I was writing the exam. When they say insurance producer, your mind be going to the insurance company. No, insurance producer is you. Insurance feed underwriter is you. Insurance underwriter is the office underwriter in the office of the insurance company. If they see insurance feed underwriter, means you are the feed underwriter. So let's look at your responsibility as an agent, as a producer, as a feed underwriter. An agent plays an essential role in what? In the underwriting process. So the underwriting we are talking about, the underwriters are brought out by the insurance company to what? To ensure that adverse selection does not continue. You are part of it. The underwriting process starts with the agent, start with the feed underwriter, start with the producer. So that may be a question that people will be looking around. Where does the underwriting process start? It starts with you, because you have first contact with the agent, I mean the client or the customer. You are the first person that talk to him or her. Any producer is required to act in a fiduciary capacity when collecting premium and dealing with the public, of course. The fiduciary responsibility we are talking about, you owe it to what? To the insured. You owe it to what? To the insurance company as an agent, because you work for two of them. So as such, all producers possess a fiduciary responsibility when engaging in insurance transaction. Of course, a producer who has made an unintentional error or honest mistake has committed a theft, known as error and omission. Are you telling me that you cannot make mistake when you are writing an application? If you say no, that is a complete lie. But what we are talking is this: is the error intentionally or unintentionally? So these are the things you're going to look. If it is unintentionally, it's an error. And it's a honest mistake that can be committed, and it's what's called a theft. And because of that, we have what we call error and omission. When you pass the exam, this error and omission is something and one thing you must have. In fact, no insurance company will do business with you without error and omission policy. You must have error and omission policy. It's a little bit insurance to pay. It's everything that everybody must have. So when you pass and get your license, you still have to go out and buy error and omission insurance. It's a liability insurance. Of course, if you're a nurse or those in the medical field knows exactly what it is. As a nurse working in a hospital or working anywhere, you're supposed to have error and omission to avoid unintentional mistake that will take you to court. So therefore, recommend that insurer purchase error and omission, E&O. It's always called an E&O in this instance. And they cover, what does it cover? The malpractice or negligence of producers. You can't tell me that you will not keep fly. You can't tell me that you do all those things perfectly without any error. You know, it's not possible. You write an application, you can't tell me that those applications 100%, you guarantee that everything in that application is as correct as it is. That is lie. So based on that, to avoid an error that will take you to court, that people will, you'll be sued for it, it's better to have error and omission, E&O insurance to cover you for such negligences. So you must have error and omission insurance. And let's look at proper solicitation. How do you talk to people? This business is always business of talking, business of speaking out. You have to speak out. You have to talk to people, explain to them why they need it. Remember, in as much as we say you are helping them, most of them do not understand until they are fully educated on why this is very important. So The way you solicit for business is another thing. So as a representative of the insurer, remember an agent represents the insurer. The insurer is the insurance company. An agent has the duty and responsibility to solicit goods. That is profitable business. So it's their duty to solicit for business through speaking to other people, through educating people. More especially nowadays that we have put a wonderful education to the business. Much advertisement now is made by you, the agent, the producer, or the field underwriter. The insurance company do not advertise as they used to do because now education has taken over. We have taken it upon ourselves to make sure that our communities are educated. That our community understand that insurance is not only about death, it's also about the living. It's also about creating a good estate. It's also about making sure that we retire freely and happily. So that is what's embodied in it. It's no longer about death. Everybody before, when you talk about life insurance, their mind will go up, oh, it's death. No. Far be from it nowadays. So therefore, an agent solicitation and prospecting efforts should focus on cases that fall within the insurance underwriting guideline and represent profitable business to the insurer. By getting your license and doing the business, you have also agreed to be responsible in dealing with your customers. Remember, when it comes to something that involves people, you are actually serving people. Means that you have to treat them with respect. That's what it is. So at the same time, the agent has a responsibility toward the insurance buying public to observe the highest professional standard when conducting insurance business. So that is proper solicitation. Does insurance interest exist? Of course, all of us, we define insurance interest before. The question now is, do you think insurable interest exists? Of course, I think insurable interest is vital to life insurance. It's crucial, very, very crucial. If you know what insurable interest means, you know that it's crucial, not only for insurance, life insurance, it's crucial in everything we do. If you have insurable interest in somebody, you try to protect the person, you try to make sure that the person does not fall. You will be there for that person. Anybody you do not have insurable interest with, you do not have any business, you do not have business with that person. Even if you have, the closeness is not there. The commitment may not necessarily be there. If you don't have insurable interest with somebody, you are doing it, just do it because you love to do it. You are not mandated to do it. But somebody you have insurable interest on, you are forced somehow to help, even when you don't want to help. So as established previously, an insurable interest exists when the insured's death will have a clear financial impact on the policy owner. So this person you're going to write policy on, if that person is no longer there, the death of that person will create a serious financial impact on you, being the policy owner. So that's why you have insurable interest on that person. If such a thing does not exist, you don't have insurable interest on the person, and you don't have any right to write policy for that person. Then, therefore, when applicant and proposed insured are the same person, when the applicant and the proposed insured are the same person, that is when you are the insured are also the policy owner. There is no question that insurable interest exists. If you are the policy owner and the insured, do you have insurable interest? There is no question that insurable interest exists, which means insurable interest do exist. If you don't have insurance interest on yourself, you will not go out to have a policy for yourself. So insurable interest exists when you are insured and also the policy owner. So there is, however, questions arise with third party. Third party is when you see somebody on the road, somebody you don't know, you want to put policy on that person, so you can become the policy owner and the person become insured. That is third party. So those in which the applicant is not there, insured. More especially when you put policy for your son, for your daughter, for your grandma, that's also third party. When you see somebody on the road, that is the third party. And that's why we cannot ask, does the insurable interest exist in such? When you see somebody on the road, you write policy for him, you write policy for your grandma, for your grandpa, for your children. The question is this: does insurable interest exist? Of course, insurable interest exists. If insurable interest does not exist, you cannot write policy for that person, which means in a stranger who you do not have insurable interest on, you cannot write policy for that person. But however, you can write policy on the person you have insurable interest, such as your children, your husband, your wife, your mother, your parents, your father, your cousins, those who are living with you. Those are people you have insurable interest, because if any of them dies, you will have a serious financial loss. So that's the people you have insurable interest on. So insurable interest cannot be established sufficiently by sentimental attachment alone. So you cannot just say, I have insurable interest on something you don't have insurable interest on. So look at the following list of situations in which insurable interest automatically exists. An individual has an insurable interest on their own life. Yes, I said it before. You as the person, you are the insured, you are the policy owner. You have insurable interest on yourself. If you do not have insurable interest on yourself, you cannot write a policy by yourself. A husband or wife has an insurable interest on their spouse, of course. A parents have insurable interest on their children. A child has insurable interest in a parent or grandparent. A business has insurable interest in the lives of its officers, directors, and the key employees, including employees who produces high volume sales. Remember, it's a business have insurable interest on their key employees. So this is the reason why you should have key employee policy, because the business have insurable interest on the key employee. Now, does the business have insurable interest on their directors? Of course. So if you are the director of company, you own your own business, you are the director, you have insurable interest, that business have insurance interest on you, which means that business can write policy and become the policy owner for you and pay for the policy. And one good thing about it is when the business pay for your policy, that payment becomes a business expense. So in that way, you do not pay tax on them. So therefore, why don't you, who have some small job, some small company, who manage some small business, no matter how small it is, go and get key employee policy, get executive, write policy on the business using the directors. So when you do such, you're gonna pay those money you pay in the premium, you're gonna use it as what? Business expense. Therefore, your tax will be reduced. Remember what tax, now that we're in tax season, what tax is? They bring out your earnings for the year, your income, they bring out your expenses for the year, they do the subtraction. Whatever remains is what you're gonna pay tax on. So if your expense is more than your profit, do you think you're gonna pay tax? No. In fact, the government will refund you money because they owe you. But if your profit is more than their expense, what happens? You're gonna pay more. So that's the tax we are talking about. You're gonna pay more. So if you do a executive bonus, do a key employee policy, executive policy, if you do all those, you're gonna pay those money to your the money you pay on the premium to keep the policy are what? What are the business expense? Therefore, when you are calculating tax, what happened? They are in the expense. You're gonna do what? Reduce the profit you make, and you're gonna therefore pay less tax. But some people do ignore it. See, business employee policy and business policy, all those are legal. They're not wrong. You're not doing wrong thing. You like if you have a key employee policy, why do you do key employee policy? In case if that person dies, or in case that person is disabled, you can be able to use that money to train other people, another person who will replace that person. That money will keep the business intact until you get a replacement for that person who passes. So that is not legal. That's not illegal. So do your key employee policies. They are it's very, very necessary. All right. Amount of insurable interest. I'm going to talk about that. Amount of insurable interest. If you have insurable interest, you have insurable interest. If you do not, you do not. What am I going to do? So let's talk about disclosures, buyer's guide, and policy summary. Let me tell you, in every business, there's always a buyer's guide. If you go now and buy fridge or buy a microwave, if you open it, there's always a buyer's guide in it. That guide is what's going to teach you what that product is and how to use it, preferable, how to use it. So I'm challenging those who are coming to Dallas, November 5th to November 7th. When you come, you see a lot of February 5th to February 7th. So I'm challenging those, if you are coming to Dallas, when you come to Dallas, February 5th to February 7th, you will see a lot of insurance companies with their table lined up. Go there. It's free. Go there and make sure it gets buyer's guide. There's a lot of buyer's guide. There's a lot of buyer pens. There's a lot of things that could be they brought to market their different insurance company. Collect as much as you can. Don't come and do as if you go, you buy it. No. Go there, get some pen, get some instructions, different instructions from different insurance companies. Get them. It can be a marketing tool for you if you get home back to your bed. Get them there. Some of friends you can give. Oh, I went to Dallas for this event, and look at this pen. I have it. Please take it. Use it. This is for national. In fact, as I'm talking to you now, I'm using Nationwide pen.
Wow.
So, yeah. Yes, and I'm talking to you. I have a lot of. I have Nationwide a lot. I have Transamerica here. I have all of them. So when you go, don't do as if you're going to pay. Go through all those tables, collect them, collect key holders, collect all those things. When you go, give it to people. It's a kind of marketing what you're doing.
Exactly.
Yeah.
Marketing.
So yes, get it. Then if you go to Las Vegas, you have to get a separate bag, a separate big bag that you can put all those things when you are coming back, because you're going to get a lot. So you have to have a separate bag you can pack them when you are coming back.
Las Vegas, right?
Yeah, if you go to Las Vegas, because there you see multiple companies lined up.
Las Vegas is July, right?
Yeah, just Las Vegas is July, yes.
That's the one I want.
So when you come, particularly when you come to that, make sure you get pens, make sure you get booklets. So those are buyer's guide. It will give you some understanding about all the product, the type of insurance policies, and the type of insurance. No, we have two basic types of insurance. I hope everyone knows that. And we have policies, type of policies that are attached to each different type of life insurance. For instance, in term insurance, we have 3 types of policies. Who can remember?
We have level term, we have decreasing term, we have increasing term.
Correct. So that's for term insurance. So if you go to whole life, a whole lot of them on whole life or permanent life insurance, we have a whole lot of them. So buyer's guide is a generic publication. Of course, there's no other way to speak about that. Then the policy summary. You just get your booklet now, the insurance booklet. If you open the booklet, in one of the pages, you see what they call policy summary. That policy summary will describe the specific product, the kind of policy you have. It's gonna tell you, who the agent is. It tell you who the insurance company is. It show you the policy number. It show you the riders you have.
Okay.
It will also show you the premiums. If you have that policy in mutual company, it show you the dividends. If you get definite or not. It's going to go show you the benefit amount, which means the death benefit amount. It's only going to show you the cash surrender values. It's going to show you the policy loan interest and life insurance cost indices. So policy summary has a lot of information about you. That's why in group life insurance, the one you have at your work, they do not have, because they don't give you the certificate of insurance. In that, you don't have any policy summary. Remember my experience when they were asking me, how much do I have? I told them, I don't know. Because what the company does not give me coverage certificate. By law, if you have group life insurance, your company will give you certificate of insurance. Certificate of insurance. Why they will give, they keep the master contract. So your company is supposed to keep the master contract and give you the certificate of insurance. So if you have the certificate of insurance, you will know the information about the policy you have. That is what the law says. But if anybody here who his company or her company has given certificate of insurance, please tell us so we know the experience. They don't do it. No, that's the truth. They do not do it. They don't give it to you. Most often, you don't know whether there is a policy exists or not. But however, they say they have group life insurance. Until you come out, that's when you know that some of this is just they're using it to write. They're using you as a business expense while they do their job and make their money. I'm telling you the truth. So another secret thing I want everybody to know again, if you get a job, they tell you that, they have a group policy for you, group policy for you. What the question you have to ask them in that interview is on that group life insurance you have for me, or the health insurance you have for me, is it contributory or non-contributory? If they say it's contributory or non-contributory, ask them again, how many percentage is the ask them again, how many percent are they contributing? And how many percent are you, the employee, going to contribute? If you ask them this question, in fact, they will look at you and say, where this person is coming from? Because they know you are trying to expose them. Most of the interviewers may not know it, or some of them may know it. Ask them what percentage, if it's contributory or not contributory. If it is contributory, how many percent are they, the company, the employer, going to contribute? And how many percent are you going to contribute? So if you go to interview in two places, your choice now is not going to be based because they are giving you insurance, which you don't know what it is. Your choice now will be based on which of the companies contribute greater percentage. That is what will be your choice. Which of the company is contributory? And if they are contributing, what percentage are they contributing? That will base your choice of making choice of the two companies. Not when they tell you that they are giving you insurance. You don't know what it is. Of course, all of us was a victim. Even me. All of us was a victim. Now, let's assume I'm going to get a job now. You say, oh, you're going to offer me life insurance. You're going to offer me this. You're going to offer me that. I'm going to ask a question that will shock you now. That's how they ask me, I don't ask question, any question. I say, all right, thank you. He said, you guys are offering me health insurance and life insurance. What kind of life insurance is that? And if they tell you, say, all right, is it contributory or non-contributory? They say it's contributory. Say, oh, how many percentage is company going to contribute? And how many am I going to contribute? If you ask them that question, they will be because that will be the basis of you making a choice. Not just because they say offering you life insurance, you go. No. No. All right. So let's look at the example. It says agent must provide the required disclosure before the first premium. What is that disclosure? Is the information you have to sign when you fill the form. That disclosure will give the insurance company, the underwriter, the power to source for those information that they use to either approve you or deny you policies. So that is disclosure. Of course, you sign disclosure in medical field. If you go to hospital, you have to sign disclosure. So such disclosure is equally signed in life insurance policies. That will give the underwriter the legitimacy to seek for your information. So that is what it is. Now, the purpose and
Professor, Professor, you said the disclosure allow the underwriter to go get the information on you?
Of course.
Okay.
Yeah, without you signing the disclosure, they're not gonna get they're not gonna be able to get the information from you.
Okay. Oh.
key points this year. We want to make sure that we are not too much in
Sorry, please.
in
Please, I can't hear you.
Sorry.
Not talking this way.
Uh-huh.
Okay.
Sorry, please. I didn't know that it went off. So one of the primary responsibility of an underwriter is what? Is to protect the insurer against what? Adverse selection. We have been able to what? Define what adverse selection is. So the only reason why insurance company can survive today is because they have fought and be able to fought adverse selection. So that's what it is. So any question up to now? Of course, everybody understood adverse selection. Sorry.
We can't hear him.
Yeah, just give me a second. I'm trying to get somebody out from my phone. Just a second, please. Sometimes there's some things that can hold you tight. This one hold me tight, but I've taken excuse from them. All right. So the adverse selection, just like we said before, everybody knows what it is now. Nobody will say he doesn't know what it is, and nobody will say he doesn't know why underwriters come into force in insurance business. Nobody can tell us now that he doesn't know what underwriters are and what is adverse selection and why underwriters are in business of insurance. Without without adverse selection, the underwriter's business will be useless. So because adverse selection is there, underwriters were introduced to the insurance business. If not, look at what he said here. He said, issuing a policy to an uninsurable person is an unwise business decision that can easily result in a company's financial loss. So one of the primary responsibilities of an underwriter is to protect the insurer. Who is the insurer? The insurance company, against adverse selection. Here now we say, remember, adverse selection is what? Is the underwriting concept that involves the tendency of poorer risk to seek insurance coverage, or the change that an insurer will accept applicants who are bad risk. That is, those who are poor head, who are moral hazard. We have talked about moral hazard. Moral hazard is what causes a risk. So simply put, those who are most likely to experience a loss are also most likely to seek insurance. So you see, you can see that adverse selection, underwriters are doing a great business. If not, some of us who are not approved today will be approved. So that is the business of underwriter, and that they are there to check or to protect insurance company from against adverse selection. Because what? Those who have poor risk, those who have poor health conditions, those who are moral hazards, we go for what? Insurance coverage. They'll seek for insurance coverage. And if underwriters are not there, they will be approved. And when they're approved, company will be on adverse selection. And if companies are on adverse selection, we lose money. They will lose money. And when they continue to lose money, what will happen? They will fold. So that is basically what adverse selection and what underwriters are. So, for example, a person with life-threatening disease is typically more concerned or eager to obtain insurance coverage due to what? Due to the probability of imminent death than a healthy individual. You can see what I said before. People go for, when people suppose get insurance policy, they don't go for it. They only go for it when they think they will not get it. So your education here in our community is to try to reverse it, that people should get policies when they don't need it. When they need it, they should not look for it, because when they need it, they will not get it. They will get it when they don't need it. So if you have a policy for your small boy or your small girl, does she or he need it that time? No. But when something goes wrong, that is the time they need it. And if you go for that time, you're not gonna get it. He's not going to get it. So it's our responsibility now as an agent to make sure that our education to people around us will be, they should get policy now, even they don't need it. And for those that you approach, they tell you that, look, I got it all. They don't get nothing. They just need consistency. They don't need continual disturbance until what? They understand what it means. They can go from different angle. If it's a spouse, husband and wife, the husband is always a thick head, just like me, but like every man is always a problem when it comes to that, because we think and we feel we know better. It's an ego. It's a manly ego that is planted in every man. It's go through the wife, convince the wife can be able to tell the husband at the point the husband will understand the need. Believe me, if you understand the need for it, everything will be easy in the family. That's the truth. I hear some family, most time they fight because of account, placing of this person. We have to have one account, family account, where you pay your check, you pay into that account. They pay the husband the check, the husband pay to the account, a single account for the whole family. That is as dangerous as bomb that will blow up one day. Yeah, but the husband or the wife will not understand that until such person come to this kind of place. I'm telling you the truth. There's no man here listening to this and understanding what we are saying today that go back and tell the wife, we're going to have a joint account. That will be account that contain all the money in the house. There's no man who do that. But if he is not exposed to such training today, or what we are seeing, what you are reading as a person, he will insist that it must be one account. So that is the basis of it. So it's something you're going to gradually, all of us gradually have to educate ourselves. We need it. We need it. We need it. Honestly, we need it. So let's look at, all right, let's look, I don't think there's something new here. Except for, all right, remember adverse selection is the underwriting concept that involves what? Tendency of poor. We have talked about that. Such, all right, just as each insurer determines the what premium rate, it will charge its policy owners. Each insurer also sets its own standard of what constitutes an insurable risk versus uninsurable risk. So what you can think about here is that you have so many insurance companies. Where we are and where you guys are coming into, WFG houses more than 100 plus insurance companies that offers different types of insurance and different policy types. So if you accustom yourself with most of the policy types and types of insurance, you will not be able to educate your clients based on their family needs, based on that client's need, because buying policy must be based on the needs of the family. Are they more favored towards protection? Are they more favored towards acquiring more cash? Are they more favored towards making sure that the whole family have a good retirement plan? So this is a whole lot. So it depends on what you as a person is. Now you have a policy, you have one policy. Is that policy towards giving you a maximum protection? Is that policy towards giving you a good retirement? Is that policy towards providing a financial base for your family? So these are the things you have to check. It's not just writing policy. It means a lot. So you see some people having up to 4 or 5 policy. Each of them, they channel it to different needs. You wrote this one, you say for this needs. You wrote this one for this needs. One policy cannot cover all of them. That is the truth. It cannot cover all of them. But however, get one first. Start from one. Start from one. So underwriting, another term for risk selection. You can see another word you can use for underwriting is risk selection. Risk selection. So if you see it in the hall, in the exam, don't get freaked out. Another name or another term for underwriting is what? Risk selection. Of course, the select risk. What is it? It's the process of reviewing the many characteristics that make up the risk profile of an applicant to determine whether the applicant is insurable or not. If so, a standard or substandard rate. So the two fundamental questions that underwriters seek to answer about applicant are what? If the applicant and the insured are two different people. If the applicant and the insured are two different people, does an insurable interest exist between them? Is the applicant insurable? So that's the two questions. Most important question. Is the applicant and the insured two different persons? Is there any insurable interest existing between them if the applicant and the insured are two different people? Again, is the applicant insurable? So these are the two questions they want to answer. And is the applicant insurable based on the risk classification? Is the applicant two different people or the same? Exists between, they want to find out the insurable interest. So these are the things. And that is why, once again, remember this, if the insured is not the policy owner, there's always an insurable interest during the time proceed will be paid, which means during the time death benefit will be paid. There's always a question of insurable interest. When the insured is not the same as the policy owner. And moreover, when that policy owner is more especially the what? the beneficiary. So that's why there should be they ask for insurable interest during claim, when you submit a claim, during claim payments. But if not, they're not going to ask. If the policy owner is not insured and the policy owner is not the beneficiary, so there'll be less question to ask. Because if the policy owner is not insured and the policy owner is the beneficiary, definitely the insurance company want to know why the policy owner is the beneficiary and who is that person that he or she want to benefit from. So that question of insurable interest will come up even in time of payment benefit. If not, insurable interest starts with application and ends with application submission. All right. So I think we're gonna move ahead. Let's look at, I think that's what we just did now. Let's look at the proposed insured. Is the proposed insured insurable? Of course,
Insurable.
that's one of the questions. Is the proposed insured insurable? Of course. You see, one of the things why we want to tell our people to go make sure they get insurance for our younger ones is this. You have a lot of things. Do you know that if you have a driving record, you get up to 5 to 6 tickets from police? They will see you as a risky driver. And if you're a risky driver, what does it show? The person can get accident and die. And what does it show? Your risk classification will be substandard. Sometimes they will even deny you. They can deny you policy by May you have collected a lot of tickets, more especially speed. And you ask yourself, how are they gonna know? Remember the data, MIB. So MIB have everything that you do. The medication you're taking, your driving record, any case you have in court, whether convicted or not convicted, everything you have, where you live, where you work, how many times you work there. If you have committed any fraud, all those things are in MIB. So that's where they're going to get it. They want to know whether is this proposed insurable. This applicant is insurable. So that's one of the questions the underwriter want to ask. So once it's determined that insurable interest exists, the next question will be whether the proposed insured is insurable. The answer to this question lies in the underwriting process. The underwriting process involves reviewing and evaluating information about a proposed insured and applying what is known about the individual against the insurance standard and guidelines for insurability and premium rates. Remember, your risk classification is what determines your rates. Your health condition determines what? Your risk classification. Your risk classification determines what? Your premium. Your social life is what determines what? Your risk classification. And those risk classification determines your premium. Your hobbies, your occupation determines your risk classification. And those risk classification determines your premium. So therefore, if you are working in a high-risk job, occupation, your risk classification will be high. And therefore, your premium will be high. So all this is what comes to factor. Of course, if you're a man, your risk classification will be high, means your premium will be high. So these are the things we should know. These are the things we should know as a agent to be. So previously examined, the most common way to manage risk is for what? For an individual to transfer it to insurer by purchasing an insurance policy. The most competent way to manage what risk is what? For an individual to transfer the risk to what insurance company. Of course, I said this yesterday. If it's possible for me to transfer all the risk, even the risk of paying home mortgage, if it's possible, I'll transfer it to insurance company. Every risk, transfer it to insurance company and live a good life. Yeah, if it's possible. No, if it's possible. However, it's possible some people who are well rich transfer all of them and leave. In fact, imagine when you are now, somebody's paying your mortgage. Somebody's going to Walmart to buy things for you. Somebody's cleaning your room.
What's the mess?
Yeah, you just come into the house, you take a shower, and lie down on bed. When you wake up from bed, you enter your car, you go play tennis, go play golf, come back, go to one good restaurant and eat, come back, take a shower, sleep. Imagine that kind of life. Is it?
You know, nothing remain again.
Yes, that's what I'm saying. It's possible. We transfer the risk to the insurance company. Let them manage. We pay them. Let them manage. That's the way all these rich people do. That's what they do. They transfer everything to the insurance company and they live a good life. Until when God will tell them to come back. So one of my friends will say, "But do you know that the heaven we are talking about here is here on earth?" Say, if you're not able to live good life here on earth, you say you're going to heaven. When you go there, you suffer. I laugh. So the heaven should start from earth by you transfer all the risks to the insurance company and start living a good life. So an insurer cannot insure every type of risk presented. For a pure risk to be insurable, it must involve a chance of loss that is accidental, measurable, and definable, and cannot involve a change for financial gain. So the only type of risk that is insurable are called pure risk. Please, that is an exam question. They say, what kind of risk is insurable? It's only pure risk. Why pure risk is insurable? Because it's accidental. It's measurable and
It's
definable.
not planned.
Yes, it's not planned. It's unintentional. So that's why only pure risk that is insurable. Every other risk is not insurable. Now that takes us to what we call the law of large numbers. In such cases, you have known whether a person is insurable. They want to apply the law of large numbers to determine what happened in that community. The law of large number is a mathematical law, but nobody is telling you to solve mathematics. Of course, the mathematical law of probability, which states that the larger the number of occurrence, that's the larger the number of lives covered, the more predictable the losses will be. Let me take it again. The law of large numbers is what? There is a law of probability. What does it state? It says the larger the number of occurrence, the larger the number of lives covered, the more predictable the losses will be. What does it tell us? Tell us that, look, if we are 500 people, the chances, let me use literal word to explain that. If we bring 500 people here today and bring 10 people, the chances that out of that 500 people, 5 people will die in a year will be higher than the chance of from that 10 people, 5 people will die. The chance of 500 people, 5 people will die in a year is there. Than when you bring 10 people, the chance of 5 people dying from 10 people will be slim. It will be very low. So that's exactly what that number is. The larger the incidence of problem in terms of risk, in terms of disease is there, the tendency of that disease occurring will be there. So the larger the number of lives covered, if you're in an insurance company, the larger the number of lives you cover, the tendency of you paying losses will be there. So that's what we call law of large number. Any question? You should understand what law of large number is. They always use it to ask questions. Any question on that? All right. So we said as the number exposures increases, a number of exposures increases, the actual result will more closely approach the expected result of a specific event. In other words, the larger the number of homogeneous units, that is smaller risk, the better our ability will be to predict aggregate losses. So other element of insurable risk are what? The losses must be significant enough to cause financial hardship. The loss must be catastrophic. Let's not, we should waste our time here. Parties involving in underwriting. Who are involved in underwriting? We say in insurance contracts are between two people. So who are the playmakers? Who are the people responsible in underwriting? Who play some part in underwriting business? Of course, you as a applicant, you are one of them. And the insurance company is one of them. Of course, the producer, feed underwriter, is one of them. And again, the underwriter in the office is one of them. So underwriting is a collaborative process involving several key players with distinct responsibility. As a new insurance professional, you will do what need to understand not only your role in this process, but also how you interact with others. When your client asks who will be reviewing the application, you should do what? Be able to explain each person's contribution to the final decision. Of course, they're going to ask you. You know, people are too inquisitive. They're going to ask you who is going to take decision, who is going to approve this policy. That question is higher than you. You just tell them, say, insurance company. Now, who there in the insurance company that will take the decision? The underwriter. So look at this. I'm going to highlight something. I want everybody to pay attention. It says for state exams, a person needs to understand the parties involved in underwriting process to answer questions accurately. So go to your state, find out who are the parties responsible for underwriting process. You need to understand that. It's a producer needs to understand who they need to speak with to complete and sign insurance application. Also, producers need to know who to reach out if questions arises regarding insurance application and or insurability. For you, when you start your business, you know one of the people you should get in contact with are the insurance company. Because they're going to answer your questions based on why this policy is not approved and why it's approved. So if you're coming to Dallas, sometimes you see some of the insurance company, their representatives, sometimes their managers will come. When they're there, or not that they will come there, they will be there. So when they want to speak, they will give you numbers. You can reach them if you have any question on your client's application. Those numbers, they'll be flashing the number, tell you to copy, call so person if you have problem. So you can, this business actually is not a difficult one because you have a lot of resources that helps you to do it. Believe me, you may not even know how to put the application. Let's assume you don't know. If you call them, they will direct you. So there's a lot of resources. And again, let's assume you don't know how to do the application. You pick your phone, as I am now, you call Bart. I have this person that I want to speak to, and we're about to put the application. I don't know how to do it. I will jump into the Zoom. You take your phone, you call the person who brought you to the business. Oh, I don't know how, I have so person, don't this, I don't know it. The person will jump into the Zoom. So it's not business that you do alone. We do it together and we win together. That's what it is. No, there's nothing like, it's not those who come from Africa. It's not WAEC that you want to pass alone. It's not class work that you want to carry first. There is no first position here. We are fighting together and we are going to win together. So when taking application for potential insured on behalf of the insurer, a producer performed the extremely important initial step in the underwriting process, referred to as field underwriting. So you are the producer, you are the field underwriter. The first process of the insurance application is what's called the field underwriting. And who carried that field underwriting? You, the agent, you, the producer, you, the field underwriter. So you carry out that first important underwriting process, the field underwriting. So during this process, what happened? The producer determines which risks are desirable and submit those to the underwriting department for approval. Remember, if somebody has written your policy, remember the person asks you this question. The person asks you where do you work? What do you do? The person again asks you, are you taking any medication? If you're taking a medication, why? Who is your doctor? Where is your hospital? They ask you a lot of questions. That's the process of underwriting. They're trying to get information they're going to put on the application. And that's why some people, after filling the application, you send to the underwriter, you'll be approved immediately. It's based on the information you submitted. Some people, after submitting the application, within 6 months, they are still considering it. They are still looking for information to be able to either to deny you or to approve you. Some people, they submit the application within 24 hours, it's approved. So that's based on the initial step of field underwriting, which you, the agent, the producer, and the field underwriter do. So that's what you know. So another thing the producer is also responsible for providing any required disclosure of information practices to an applicant, such as what? Notice regarding replacement, a life insurance buyer's guide, and an outline of coverage or policy summary. Life insurance buyer's guide. Come to Dallas, make sure you pick some. That's what I would say. If you come to Dallas, do not miss them. Make sure you pick some. It's on the table of every producer. I mean, every life insurance company. You see a lot of life insurance company there. Those will come. I know there'll be more than 10 or more than 15 or more than 20. So go there on different tables. Make sure you grab some of the guides. All right. So let's go to parties involved in underwriting. The applicant. Who is the applicant? That person who wants to write policy. That person who wants to be covered. He is the applicant. He is simply what the person requesting the insurance and completing the application. The applicant or the proposed insured. The applicant is called the proposed insured. The proposed insured is the person whose life to be insured, if approved. The policy owner retains all of the policies, rights, and options if the application is approved. So we said the insured can be the policy owner, but sometimes the policy owner may not be the insured. Then the policy owner also typically serves as the payer. If you're the policy owner, you're the payer because you pay for the policy. Who pays the piper, they take the tune. You manage the policy, you take a loan from the policy, you will make a withdrawal from the policy, you do everything with the policy. You change the beneficiary. So all the power belongs to the policy owner, more especially when you are not the insured. All right. So let's look at the exam tip. I don't want us to go to the summary. The exam. Let's look at the exam tip. He said, although the parties of an insurance contract can be very complicated, the vast majority involve one of the party, typically the policy owner, payer. Remember, the policy owner is always the payer. I hope everybody should know that. The policy owner pays for the policy owner pays for the policy. He's the payer. The applicant is you who is applying for policy. And proposed insured is also you. You are the applicant. Are all the same person. So, for example, assume there is this case unless what a question typically suggests otherwise. So, you see what it said here? The policy owner, the payer, the applicant, and the proposed insured all are the same person. Because what? Let's assume you are the policy owner, you are going to be the insured. Is the policy owner not the insured? Yes, of course. Is the policy owner not the payer? Yes, of course. The policy owner pays for the policy. Is the policy owner not the applicant? Yes, of course, it's the applicant. Is the policy owner not the proposed insured? Yes, of course. So all these are the same thing. However, it depending on the terms they are used. But if not, all of them are the same. We're gonna go front. I want us to see some other thing. Insurable and the underwriting process. Insurability and underwriting process. I don't think there's much thing to say here. Pre-selection underwriting activities. Of course, what does this involve? It involves the process by which the agent, the producer, complete the initial application prior to submission to the underwriting department. Appropriate activities include, when you finish filling the application, what next do you do? One, you obtain a complete and detailed answer to all policy application. In fact, when you are filling the application, all those areas required to be filled must be filled. Insurance company does not take half information. You must fill it and fill it correctly. You know what they're trying to avoid? They're trying to avoid impersonation. They're trying to avoid not detecting when the risk is high. So you have to provide insight with regards to possible underwriting rating services. Of course, the underwriters also rates. They are also involved in rating services, stressing the importance of answering all questions honestly. Everybody gotta answer the question correctly. Do not jump anyone. Make sure all of them are covered, all of them are answered, Post-select activities, underwriting outcomes. Of course, you know what underwriting outcomes can be. When you finish, either the person will be approved or not approved. We got book club today. This is another thing that all of you should log in to listen. I beg, there's a lot of education going on. We had our book club today. We had close to 370 to close to 400 people that log in, where everybody is sharing his or her own experience. We have a lot of experience to share. In fact, today, book club mostly is based on home mortgages. Based on questions on mortgages. People are giving out different information that benefits you if you have a mortgage, honestly. That benefits you what you pay, what they charge you, and how you can get out of some of those charges. It was so good today. So privacy notice, if you don't sign consumer, that's disclosure, you cannot be able to access some information. The privacy notice, of course, the Health Insurance Portability and Accountability Act of 1996 is a federal law. What does it do? What does HIPAA do? HIPAA is a federal law that established national standard to protect sensitive patient health information from disclosure without what patient consent or knowledge. So, you know something that before now, we think HIPAA is only for health to protect person's information. No. It's one of the things they need in insurance. So let's look at this. He said, when an agent submits an application that reveals an applicant's personal information, the agents must provide the applicant with what? Privacy notice. Of course, privacy notice, they sign it when you are doing the process of signing the application. An applicable situation, producer must also secure a HIV consent form from the applicant and inform the applicant that blood tests may be required underwriting services practice. You see, one of the things the underwriters do, and which we have experienced, is that sometimes during the underwriting process, you discloses some illness that some people are undergoing, which they don't know. I've known at least about 2 to 3 people that because they want to write policy, they found out that they have 1 or 2 problems. Some of them don't know they are diabetic, but because they want to write policy, when they finish all those tests, they now discover what they don't know that exists in their life. So there's no way you want to write policy as a loss in this business. No, I'm telling you. So HIPAA mandates what the applicant that must receive a privacy notice outline how their personal health information will be handled. Exams often test your understanding on when and how privacy notices are required, of course. The application. Now that we begin to get into the business of application, this is where it becomes interesting and somehow confusing. The application you fill are in 3 essential parts. If you have filled application for policy before, or somebody has written your application, the question they ask you, the information you provide, the representation. Remember, we say it is a representation. The representation are in 3 parts. One of them is what we call the general application information. The second part is medical and health history. The third part is the agent report or statements. Please give me a second. Give me a second. Sorry, please. So that is what, how the application are classified. The three essential parts of application: the general applicant information, the medical and health history, and the agent report or statement. So one of the things you will do immediately you get your license and get your license verified, you get that into the platform, is to start to practice how to do application. One of the things you do. You're not going to do it alone. Somebody must guide you. Someone must teach you how to do that. It's also a simple thing. Basically, the hardest thing in this business is just for you to speak to people. That is the hardest. I'm telling you. Every other thing can be done. It's why you are there. People will do it. But the only one you have to do by yourself is to open your mouth. Dr. Ruth will always say her mouth is her office. So most times your mouth is your office. If you utilize your mouth well, what happens? You benefit from the business. You make millions within 6 months to 1 year. So, but if you do not, then there is a problem. So, but however, you have people who will hold you on by the hand and show you how to do all those. So let's look at the part 1 of the application, which we call general application information. General application information. That is the part 1. And what is there in the general application information? One of it is type of policy, amount of insurance, name and relationship of the beneficiary, other insurance owned by the proposed insured, and any additional insurance application that are pending for the proposed insured. So that's what the first part of the application, which is called the general application information. So that is it. Now, the other one is what? The part 2, which is the medical. The medical and health history. Of course, through the MIB and APS, they will find out your medical and health history. That's the other part. So they said part 2 focuses on the proposed insured health and includes several questions about the person's health history, not only of the proposed insured, but also of the proposed insured family. Do you know when they ask you your family health history, it contributes to the decision the underwriters will take. If they ask you your family health history, you said your mom died of cancer, your father died of cancer. The next thing they ask you what age, you say your mom died of cancer at 65 years, your dad died of cancer at 58 years, and you are 40 years. What do you think the underwriter will do? Anybody? Anybody? I want somebody to say something.
That mom died at 65.
That's what they're gonna die at.
Let's assume they ask you in the medical and health history, the part 2 of the application, you are writing a policy, you are putting your own information, or you are writing somebody's application. And on the application question, on the health history, family health history, they ask you, is your mom alive? You say, no, died. They ask you, is your father alive? They say, no, died. They ask you, what is the cause of the death of your mom? You say, oh, my mom died at 65 years. And they ask you, what killed him? You say, cancer. They ask you, what of your father? You say, oh, your father died at the age of 56 years or 55 years. They ask, what killed him? You say, cancer. And you are 40 years or 35 years. What do you think the underwriter will do?
Either he disapproves you or he puts you on the substandard risk.
All right. Any other person?
I
You know,
would say put you on the substandard list too, because they're gonna see you as danger at her selection.
Mhm. All right. So anyway, what I want to find out there is, of course, everybody's following you. Moreover, they're gonna see you just like Miriam said. They're gonna see you as danger. That is bomb that will explode in the next 5 or 6 years.
Yeah.
So in that way, they may not approve you. They may not approve you. They will look for other information that will be strong enough to deny you the policy. They're already seeing you that this is this person, that the parent died of an accident in a younger age, and he or she is 40 years. No. In the next 10 years or next 15 years, this guy will die. So if they will approve you, they're gonna approve you of higher substandard risk based on your what? Family health history. So you see how they do all this. So what you bring out to put on the application, we decide on approving you or not approving you. I said sometimes some people can put application within 24 hours is approved. When all those things are checked and see that maybe it's necessary to approve them, then we approve you. The agent reports, of course, our statement, the agent report or what the agent reports to. Finally, after all those things, the agent will write his own report and submit. If agents say, oh, that guy is a drunkard, he smells like, he smells alcohol, do you think they will approve you? No. So the agent have to, first of all, have seen you. Even if that person is a drunkard, they know that that person don't drink to stop, or the drink may not kill the person. Or if they decide that, oh, this person will kill himself due to drink, the underwriter will not even look at you. So these are the people that participate in underwriting business. What again is completing the application. How do you complete the application? Remember, initially, we said complete the application. Whatever you write the application is a representation, please. Every statement in the application is a representation. It's not a warranty or guaranteed information. Everything you said in the application is your own representation based on your best knowledge. So it's a representation, please. Do not call it a warranty or guarantee. Do not guarantee anything, please. It's a representation, so you will not put yourself into trouble. So representation are statements made by an applicant that are deemed sustainable, substantially true to the best of the applicant's knowledge and belief. However, they are not warranted to be exact in every detail. Representation must be accurate only to the extent that they are material to the risk. If the applicant lies about their health status, it is material misrepresentation that may void the policy or lead the insurer to cancel it. Typically, the premium is refunded to the policy owner or applicant whenever the insurer cancels or declines the insurance policy, of course. If they cancel it, they will give you your money back. So if an applicant makes a statement that are guaranteed to be true, they have made a warranty. Do you guarantee that the statement you made is true? I don't think so. It's not true. So a warranty that is not literally true in every detail, even if made in error, is sufficient to render a policy void. Therefore, the statement made by an applicant and is recorded in application are considered to be representation and not warranties. This is what I want to know. I want everybody to know. It's representation. Please know this. It's very important. Scenario, material misrepresentation. So that is it. Application signatures. Of course, if you write after filling the application, there must be signature. It's the signature of the applicant and signature of the agent. The agent is you. The applicant is that person who is applying for the policy. So two of you must have their signature. There is nothing you can do with that signature. And remember, there's this thing that you see in exam. If during the application process, when if they sign a signature, and you find out there is a mistake there, you and the applicant will correct it, and the applicant have to initial on the on the application where the correction was made. The applicant has to put his initials there. If there's no initial, that correction cannot be accepted. So it's always in the exam. Initial on the correction made. If you do not, that's probably just like when you're writing a check. If you write a check and make a mistake, you correct it, you have to initial on the correction. Or if not, is null and void. So I think that's the only thing we need to know in application. I think we may definitely stop here today. What time do we start? Yeah. We're going to stop here today. We're not going to finish. It's a lot. So we definitely may finish. We are what? 43%. We may finish on Monday. So we're going to stop here today. I think we're going to stop here today. We're going to continue on Monday by 8:30. By God's grace, we might likely finish on what? We finish this chapter 7 on Monday by 6 p.m. We finish, but we do Monday 8:30, then Monday 6 p.m. So for others, please just read on your own. Read, most especially your set part of the questions. Read them. Julian, you that will write definitely this week, please read. If we tell us when you are going to write, check within the chapters. I'm speaking to Gillian now. Check within the chapters. Any of the chapters you think that you do not understand well, you can tell us. We may do it the first thing on Monday by 8:30 a.m. if you be available. If you check all the chapters, any of them you think we are not serious, you don't understand well, you tell us, we can go through it fastly with you. It's just like doing the revision for you. So we can do it Monday by 8:30 in the morning, if you be available.
No problem. Thank you. I appreciate that.
Or even 6 p.m., depending on when you reschedule your exam. So just check all the chapters. Check anyone that's difficult, anyone you cannot understand. Let us know. All of us can go through it before you go for your exam. We always do it to everybody who is about to write his or her exam, because we want anybody to go there to pass. That is just our aim. All right. Thank you, everybody. And is it good night or good evening? See you guys on Monday by 8:30 a.m. Thank you.
Thank you.